Afraid to ask questions and seek out different perspectives. Remember, knowledge is power. The more you know about investing, the better equipped you'll be to make informed decisions that align with your financial goals. Section 5. Long-term vision, your North Star in investing. Investing is a long-term game. Don't get caught up in short-term market fluctuations. The stock market goes up and down, but over the long term, it has always trended upwards. When you invest for the long term, you have time to ride out market volatility. You can ignore the daily noise and focus on what really matters, your financial goals. Develop a long-term investment plan that outlines your financial goals, risk tolerance, and investment strategy. Review your plan regularly and make adjustments as needed, but don't deviate from your overall strategy based on short-term market movements. Remember, patience is a virtue in investing. Don't get discouraged if you don't see immediate results. Stay the course and you'll be rewarded in the long run. Section 6. Diversification. Don't put all your eggs in one basket. Diversification is key to mitigating risk in your investment portfolio. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, industries, and geographies. Different asset classes perform differently under different market conditions. For example, when stocks are down, bonds may be up. By diversifying your portfolio, you can reduce the impact of any one asset class on your overall returns. You can further diversify within asset classes. For example, within stocks, you can invest in different sectors, such as technology, healthcare, and energy. You can also diversify geographically by investing in international stocks. Remember, diversification is your friend. It helps to reduce risk and protect your portfolio from market volatility. Section 7. Emotions, your worst enemy in investing. Emotions can cloud your judgment and lead to poor investment decisions. When you let fear, greed, or panic dictate your actions, you're more likely to make costly mistakes. When the market is going up, it's easy to get caught up in the euphoria and make impulsive decisions. You might be tempted to chase returns or invest in risky assets that you don't fully understand. Conversely, when the market is going down, it's natural to feel fear and panic. You might be tempted to sell everything and go to cash, even if it means realizing losses. The key to successful investing is to keep your emotions in check. Develop a sound investment plan based on your financial goals and risk tolerance. Stick to your plan and don't let your emotions get the best of you. Section 8. Staying the course, weathering market storms. The stock market is like a roller coaster. There will be ups and downs. The key to success is to stay the course and not panic during market downturns. When the market takes a dive, it's easy to get caught up in the fear and sell everything. However, this is often the worst time to sell. Remember, the stock market is driven by cycles. What goes down must come up. Instead of panicking, view market downturns as opportunities to buy quality assets at discounted prices. Remember, the best investors are contrarians. They buy when others are selling and sell when others are buying. Section 9. The importance of a financial advisor. If you're not comfortable managing your own investments, consider working with a qualified financial advisor. A good advisor can help you develop a personalized investment plan, choose appropriate investments, and stay on track to reach your financial goals. When choosing a financial advisor, look for someone who is fiduciary. A fiduciary is legally obligated to act in your best interests. Experienced. Choose an advisor who has a proven track record of success. Trustworthy. You need to feel comfortable sharing your financial information with your advisor. Remember, a financial advisor is there to help you make informed decisions about your money. They can provide valuable guidance and support, especially during times of market volatility. Section 10. Case study, Riding the Tech Bubble. The dot-com bubble of the late 1990s is a classic example of the dangers of herd mentality in investing. During this time, investors poured money into internet companies, driving up stock prices to unsustainable levels. Many of these companies had no profits and were based on unproven business models. However, investors were caught up in the hype and ignored the fundamentals. They believed that the internet was the future and that these companies would continue to grow at an exponential rate. However, the bubble eventually burst, and many of these companies went bankrupt. Investors who had followed the herd and invested without doing their research lost a significant amount of money. The dot-com bubble is a cautionary tale about the importance of independent thinking and due diligence in investing. Don't let the crowd dictate your investment decisions. Section 11 Conclusion. Chart your own course. Investing doesn't have to be a game of follow the leader. In fact, blindly following trends can often lead to missed opportunities and unnecessary risks. It's important to understand that the stock market is influenced by a myriad of factors, and what works for one investor may not work for another. You don't need to be a financial expert to succeed. Many successful investors started with little to no knowledge of the market. What sets them apart is their willingness to learn and adapt. They take the time to educate themselves, understand the basics, and continuously build on that foundation. However, you do need to be willing to think for yourself, do your research, and stay disciplined. This means not getting swayed by every piece of news or market fluctuation. It involves critically analyzing information, understanding the source, and making informed decisions based on your own research. Remember, the crowd is often wrong. Just because everyone is buying a particular stock doesn't mean it's the right choice for you. Herd mentality can lead to bubbles and crashes. It's essential to stay grounded and not get caught up in the hype. The best investors are contrarians. They look for opportunities where others see risk. They understand that true value often lies in the overlooked and undervalued sectors of the market. By thinking independently, they can identify unique opportunities that others might miss. They think independently and aren't afraid to go against the grain. This doesn't mean taking unnecessary risks, but rather having the conviction to follow their own analysis and insights, even when it contradicts popular opinion. They develop their own investment philosophy and stick to it, even when the market is volatile. This philosophy is often based on thorough research, a clear understanding of their financial goals, and a well-defined strategy. Sticking to this philosophy helps them navigate through market ups and downs without losing sight of their long-term objectives. Don't be afraid to chart your own course in investing. It's your financial future and you have the power to shape it. By taking control and making informed decisions, you can build a portfolio that aligns with your personal goals and risk tolerance. Develop a sound investment plan based on your financial goals, risk tolerance, and time horizon. This plan should be a living document, evolving as your circumstances and the market change. Regularly review and adjust your plan to ensure it remains aligned with your objectives. Stay disciplined, stay informed, and don't be afraid to seek professional advice when needed. While it's important to be independent, there's no harm in consulting with experts who can provide valuable insights and guidance. They can help you navigate complex situations and make more informed decisions. Remember, investing is a marathon, not a sprint. It's about building wealth over time, not chasing quick gains. Patience and persistence are key. By staying focused on your long-term goals, you can weather short-term volatility and come out ahead in the end. Stay focused on the long term and you'll be more likely to achieve your financial goals. Keep your eyes on the prize, remain disciplined, and continue to educate yourself. With the right mindset and approach, you can chart your own course to financial success.